Have you ever looked at a stock price and wondered, is this expensive? Is it cheap? Or maybe you've heard terms like high PE or low PE. Well, the PE ratio is a tool designed to help answer exactly those kinds of questions. So what is the price to earnings ratio? At its core, the PE ratio compares a company's current stock price to its earnings per share. Think of it like this. The PE ratio tells you how much investors are currently willing to pay for each dollar of a company's earnings. For example, if a company has a PE ratio of 20, it means investors are willing to pay $20 for every $1 of that company's current annual earnings. Why is this useful? Well, it gives you a quick way to gauge market expectations. A higher PE ratio often suggests that investors expect higher earnings growth in the future, while a lower PE ratio might suggest lower growth expectations or potentially that the stock is undervalued, but we will get more into interpretation later. Okay, let's break down the calculation. The formula is actually quite simple. PE ratio equals market price per share divided by earnings per share. Let's look at the two parts. Market price per share, this is the easy one. It's simply the current price you'd pay to buy one share of the company's stock on the open market. You can find this on any financial news website or your brokerage platform. For example, you can just Google AAPL and you can get the Apple's share price. And in terms of earnings per share, this represents the portion of a company's profit allocated to each outstanding share of common stock. It's calculated as net income minus preferred dividends in parentheses divided by average outstanding common shares. Don't worry, you usually don't have to calculate EPS yourself. Companies report their EPS in their annual financial statements, and it's readily available on most financial data websites alongside the stock price. So you take the current stock price and divide it by the company's earnings per share, and boom, you have the PE ratio. Now, for the tricky part, what does the number exactly mean? There's no single good or bad PE ratio. It's all about context. In terms of high PE ratio, it often indicates investors expect strong future earnings growth. They are willing to pay a premium now for anticipated future profits, whereas a lower PE ratio might suggest the stock is undervalued compared to its earnings. Perhaps the market is overlooking it. It could indicate lower growth expectations or higher perceived risk associated with the company or industry. However, a low PE ratio could also be a red flag, indicating fundamental problems with the company that the market is recognizing. Crucially, you must compare PE ratios within the same industry. A high PE ratio for a utility company, which typically have stable but slow growth, might be 15, while a low PE ratio for a fast-growing tech company could be 30. Comparing a bank's PE ratio to a software company's PE ratio is like comparing apples and oranges. Let's look at two hypothetical problems. Teknova Corporation, its market price is $150. Its earnings per share is $3, so the PE ratio is 50. A PE ratio of 50 is relatively high. This suggests investors have high expectations for Teknova's future growth. They believe its earnings will increase significantly to justify the current price. And example 2 is Stable Steel. Its market price per share is 60 and its earnings per share is 5. So the P ratio for this company is 12. A P ratio of 12 is much lower. This might indicate that Stable Steel is in a mature industry with lower growth prospects, or perhaps the market thinks it's undervalued relative to its current earnings power. You need to compare this to other steel companies and do more research. Now, it's really important to understand that the P ratio isn't a magic bullet. It has significant limitations. It doesn't account for debt. A company might have solid earnings but be loaded with debt, which the P ratio doesn't reflect directly. Earnings quality. Earnings can be influenced by accounting choices, making them potentially misleading. Cyclical companies. Earnings for companies in cyclical industries, like construction, can fluctuate wildly, making the PE ratio less reliable at different points in the economic cycle. And it's just one piece. PE ratio doesn't tell you about management quality, competitive advantages, or overall industry trends. Always use the PE ratio as one tool in your toolbox, alongside other financial metrics and qualitative analysis. I hope this breakdown of the PE ratio was helpful. If you learned something today, please give this video a thumbs up. It really helps the channel, and don't forget to subscribe for more financial and investing explanations.